Welcome to the Exit Ready podcast. Ryan Ray here as always. Today you're going to love the episode. Be sure to never miss what's going on with the Exit Ready Cohort Intensive by going to www.rgahub.com/exitready. That's rgahub.com/exitready. I'll put a link to this in the description below so you can check it out. But if you're an owner, you're not going to want to miss this. Now, let's get to the show. Jerry, it is good to have you on today. How's it going, man?
Really terrific. Thanks for having me, Ryan.
Okay, so give everyone a quick background of kind of who you are and what you do and how you fit into this larger economic space of M&A, if you will.
Yeah, absolutely. So my background's more accounting, auditing, CFO work. I was an auditor for some of the larger accounting firms on the East Coast for a good 5 years. We audited private companies. I did that for about 5 years. Then I was a CFO of a lower middle market size company in Jersey. At that point, I'm like, okay, it's time to just jump ship, go out on my own. I was kind of frustrated with, I guess we'll call it the W-2 path to a degree. So I kind of just jumped right into it. Initially, I set out to be more like a fractional CFO, but very quickly, I just started seeing this demand where everyone needed capital, established companies, entrepreneurs. So I started getting involved in arranging debt for small businesses and entrepreneurs. And really, my first deal I ever did was actually an SBA deal. And it's kind of just snowballed from there. So I've been doing this since 2018, helping entrepreneurs, searchers, small business owners procure SBA financing. And I kind of bring a little bit of a different angle because I really understand the business side of things as a former CFO, former accountant, and auditor. I can underwrite a company really well. Plus, I really know the lending side really well. So I'm able to bridge that gap and set people up for success and hold their hands throughout the entire process.
Okay, so you've got a financial background, and I've joked on here a few times now that fractional CFOs are probably the most underutilized person in the SMB world. We need more of them, more companies to hire them. I'm not one, so it's not like I'm self-promoting here. It's just I've seen this over and over again. So I don't think a lot of owners really understand the difficulty involved with, especially an SBA process. They've been running personal stuff to the business. They file taxes a certain way, and then they go to exit, and now all of a sudden it's like, well, no. I want to be paid off of this number, not that number. And it's like, no, well, you got this tax issue if you haven't done it right. So maybe unpack some of the issues and pitfalls that you've seen with owners who, for understandable reasons, ran it a certain way, but when they go to exit, it's like, no, now you've got a problem.
Yeah, absolutely. I think it kind of like the root cause of the issue is I find that small businesses really put like accounting and finance like as the lower level of from a priority perspective. Right? They tend to think, well, let's grow sales, right? Let's grow sales. It's going to fix all our problems, right? They don't necessarily have a good foundational understanding of why accounting and understanding your numbers is truly important. So I think it kind of starts there. Maybe they're more focused on the operations and sales and marketing. Accounting kind of really just gets pushed to the back burner. And then at some point they kind of wake up, say, hey, oh, I want to sell my company, and here's what I think it's worth. When in reality, they never really understood their numbers to really understand what their company truly is worth and how to value their company. I mean, on top of that, you also have a lot of small business owners that are very much tax focused, right? I get it. It's kind of tough to send that check to Uncle Sam every year. Uh, but at the end of the day, right, it's not just about how much you're paying to Uncle Sam. It's about actually reporting your activity properly and accurately so that when it does come time to sell, you have a proper framework with to evaluate your company.
So if you're running it like most small business owners do, and then you go to sell and you want to show the numbers properly, do you have to then go back and refile your taxes?
And like conceptually, I would say yes. There's always a fine line between what is allowed, what is not allowed. Right at the end of the day, you have your legal tax strategies, right? Like tax 101, back to college, right? We learned there's tax avoidance and tax evasion, right? Tax avoidance is deploying legal loopholes to minimize your income and pay less taxes. And then you have tax evasion, right? So some things are defensible, but very often things are not defensible. And the things that we've seen, for example, right, if someone took your entire family, 3, 4 times on trips around the world, right, you can't really say, hey, this is a right, this is an appropriate business expense. Um, if someone had a personal health crisis, and for whatever reason they paid it out of the business, that's not a legally justifiable business expense to reduce your income with. So going back, amending your return may be appropriate in such a case. Obviously, everyone has to evaluate that together with their tax preparer. Uh, but I rarely seen business owners go back and amend their returns, right? Because ultimately, it will mean that they're going to owe taxes. Plus, it kind of puts them on the IRS's radar as well when there's this drastic amendment filing, basically.
Yeah. Well, it's a thing to where it's it's about risk, and it's the risk of when do you start thinking about that? Do you think about it, today, or you sell, 6 months from now? Well, that's not enough time to make sure that you've done it a certain way. And so, how much is a buyer, from a buyer's perspective, are they going to argue about those things? Because the SBA, as I understand it, they're going to want to know, okay, hey, well, the trips around the world, that doesn't count, right? The buyer's not going to want that to count either. And so, how much is going to be how, I guess, maybe how thorough of a process is the seller going to have to undergo to prove that their financials are legit?
Absolutely. So, first of all, getting approved for an SBA loan is not in place of a buyer actually doing their own financial due diligence, right? So that's like number one. Everyone should be doing financial due diligence. Absolutely crucial, right? Now, just because things come up throughout the financial due diligence process that maybe the buyer could stomach, it doesn't mean that an SBA lender could stomach it, right? So you may have something that the buyer could wrap their head around, and I see this very frequently, where they take these trips around the world, for example, with their family. A buyer could say, "Hey, these are truly discretionary, and I'm comfortable with that aspect because they have been validated during due diligence." But going to an SBA lender, they're likely not going to add that back. And to the contrary, it kind of raises some red flags into the reliability and credibility of the returns and financials that the seller is presenting.
So I've told owners in the past, especially on these size deals we're talking about, they should talk to the SBA even before they talk to a buyer, just to see what the SBA is going to lend on their business, so they understand what the value is. Now, obviously, there's cash buyers and different types of financing, but SBA is rules the roost, if you will. And so it seems to me that for most owners, if you're going to sell for less than 5 million, especially, talking to the SBA at least to understand where your value is pretty prudent. Do you agree with that assessment? Hey, quick break here. If you're an owner, do you know that most companies will never actually sell? That means that all those years that you put into building your business are for nothing. If you want to build a business that's valuable, that people will want to buy, and you could make potentially millions of dollars from, go to rjhub.com or click in the link below. That's rjhub.com, or click on the link below. And now back to the episode.
100%. Yeah, we do that quite frequently. We work with business brokers who are trying to validate businesses for sale, see if they're actually viable, and then we work with sellers directly as well. I mean, I think what it boils down to is most sellers know off the top of their head, like, hey, like this is right, this is like not truly okay, right, and it's kind of a gray area or completely wrong. They kind of know that earlier on, but they sometimes do get looped in, based on seeing market conditions or business brokers pushing them to sell at a time when maybe it's not really the best time to sell, and perhaps they should be strategizing for 2, 3 years down the road. But I actually do highly recommend that work with a business broker, SBA loan broker, or directly with an SBA lender to make sure that a buyer is actually going to be able to finance the purchase of your company. Super important, and I highly recommend it.
Okay, and so maybe unpack for people who aren't familiar. You mentioned SBA loan broker. Um, a lot of owners might think just go to their bank and talk to their their Chase, or I know Wells Fargo does it, but they might talk to their local community bank, and that bank might have an SBA program, but that's probably not the best SBA bank to go for. So maybe unpack why that is and kind of how the SBA program really works.
Absolutely, absolutely. So SBA, just quickly in a nutshell, SBA 7A lending, it basically a loan from a regular bank, a regular lender, and they just have a guarantee from the SBA. You do have some non-bank SBA lenders. There's a handful of them in the country, but generally, like, just think of like your brick and mortar bank. You're walking in there. I want a loan for my company, or I'm trying to sell my company, right? And whoever the bank is that's making the loan will have a guarantee from the SBA. Generally, about 75% of the loan amount, subject to a $5 million cap under the 7A program. Now, there's something called the preferred lending program, which is basically lenders who make a certain amount of loans have this preferred status with the SBA, where if a lender does not have that preferred status with the SBA, every deal that lender puts forth actually has to get underwritten and approved by the SBA. So someone achieved the preferred lending status with the SBA, the lender can approve the loan in-house, and then just closer towards the end of the process, they have to go to the SBA, get a loan number, lock in their loan guarantee. But the point is, if you have that preferred lending status as a lender, you basically could approve the loan in-house, which is golden. Now, here's the thing. There's about 1,500 active lenders in the SBA space, okay? Now, the 7A program is a very versatile program. It's not just for business acquisitions. It could be used for owner-occupied real estate acquisitions, where the business is going to occupy the majority or all of the property that it's going to be buying. It could be used for working capital financing, inventory financing, debt refinancing, equipment, and things like that, right? So you have over 1,500 active lenders in the program, right? Now, it doesn't make sense to just, for a seller to go to their bank to have them evaluate the company, or have a buyer go to the bank that the seller is banking with because maybe they're familiar with the business. I mean, conceptually, you would think that would make sense, right? Like, logically, yeah, right. Of course, they're familiar with the business. They're more inclined to lend to the business, for the business. But in reality, it doesn't play out that way. And the short answer is because, first of all, of the approximate 1,500 SBA 7A lenders out there that are active in the market, very few of them are actually like really aggressively lending under the program. Like, you're talking about 5% of the 1,500 that are aggressively lending under the program. Okay, now within that 5%, we're talking about different credit boxes, different appetites for different kinds of deals. So, for example, like a very common thing for from a buyer's perspective, when they're looking for an SBA loan, is they'll say, hey, let's go look at the rankings, right? Who's like a top SBA lender? And it, again, logically, it makes sense. Say, hey, well, ABC Bank is a top 5 SBA lender, so let me go take my acquisition deal to them, right? But in reality, within those top SBA lenders, again, there's the credit box, there's the types of deals they're lending for. The majority of them are lending for working capital, for example, or inventory. Additionally, that you have to factor in, like, well, what's the average loan amount that this bank is lending under the 7A program? Like, if I'm trying to buy a business and I need a $3 or $4 or $5 million 7A loan, but the bank's average loan amount is $100,000, like, does it make sense to go to them just because they're in the rankings? And then you also have the fact that, okay, well, some banks love transportation and logistics, for example, but I'm trying to buy a manufacturing company. So again, you could go to a lender that is super active in the space, but you're kind of just spinning your wheels. So that's just like a couple of reasons why you need to make sure that you're properly selecting the right lender, not just basing it off of rankings, and not working just with the seller's bank as well, because again, that doesn't necessarily lead to like a closed deal.
Yeah, you hit on something really important there. I think I've spoken to people before, and I'm like, they're like, well, I wasn't approved. I'm like, well, were you not SBA approved, or was the bank not approving you? That's a different question, right? Now, there's certain types of businesses that the SBA won't work with in general, but that doesn't mean just because the SBA will, the bank will, right? And so understanding that, and so if you go to your local bank or a random bank you find on the internet, you go, "Oh, well, I need a loan for, or I want to start a business." It doesn't mean that bank likes to lend for the size or for the industry, as you mentioned. And that seems to be a big component in this process, is that understanding that there are multiple banks that will do this, but they might not love your industry or your size. And so how often do you think that kind of gets overlooked when people are going through this process?
I really think it gets overlooked all the time, there's even like a bigger point there where you have the SOP, the SASOP, which is over 400 pages long, right? And generally, the SB sets like the minimum needed to get a deal approved, right? But just remember that on top of the SBA rulebook, every lender has their own credit box too. So just because it's allowed under the SBA rules, and you found a participating PLP lender, it doesn't mean you're getting the deal through. And really, like, the unfortunate nature is, and this is just so common, and it kind of eats me up alive. You have a lot of deals die because they kind of take the approach of, let's go to the bank that the seller is with. Let's go to maybe my bank that I bank with because they're very nice to me, and when I come into the branch to make deposits, or let's go to someone who just, well, they're a top 10 lender, right? The reality is that a big part of the process is working with the right people, not just the right lender, who you're working with at the lender. The unfortunate nature is that most of the time, lenders that end up denying deals after a multi-week or sometimes a multi-month process, they could have told you off the bat just by having a 1 hour conversation with you that it's probably not a good fit for their bank. What happens is people are just going to lenders, they're working with the wrong people just pulling files in, they're doing intake, and then they're just being dragged through the mud for a good couple of months, a few weeks, a few months. And then the seller is getting frustrated, the deal dies, the seller wants to retrade. So it's just a big trap I find that a lot of buyers fall into, and then they're trying to really figure something out when the deal is kind of hanging off a cliff, which is just incredibly frustrating when you have a good deal and it's being approached in the wrong way. It's just really sad when I see that happen.
There's a stat out there, and I don't have it handy. I was trying to think of it, but it's a high percentage of owners would prefer to sell internally. So to an employee, to maybe a family member that works in the business. And you will see a lot of talk about owner financing and heavy owner financing. And obviously with the SBA, there's a little bit of owner financing. But I don't think a lot of owners maybe understand that using the SBA can get them a lot of money up front, and potentially, depending on the person's credit score and stuff like that, they can sell to an employee or a family member that works in the business, and that's a huge benefit for them because that person already knows the business, and they don't have to go to market and do all that stuff if they don't want to. So maybe explain to owners who aren't familiar with like selling it internally, they can go to SBA, get the value, and then if they have an employee that's qualified, how would that work?
Yeah, absolutely. So it kind of makes sense to sell it internally, right? You have an employee or a family member who's super familiar with the business, has been in the business for 5, 10, 15 years. It's kind of like a no-brainer to a degree. But I think there's like a couple of things. I mean, a lot of small business owners, they don't really understand how lenders underwrite deals. And I think a lot of them are under the impression that my business getting approved for a loan, yeah, that's not going to happen, right? Like, or, well, I want $5 million for my business, but the assets in the business are only worth 500 grand or $1 million, right? It's like, well, that's not really how small businesses are valued. And whoever you're selling it to could get way more than you think they could. So I think a lot of it comes from not really understanding, how businesses are valued. Can their business underwrite for an actual SBA loan? And then, similar to what we touched on earlier, like, I'll give you an example. I had a story earlier this year where I had a seller call me up and say, "Hey, I'm trying to sell my company to a group of employees, right? A group of current employees." And at the time, this was before the SOP change earlier in the year. At the time, you were able to get 100% financing if an employee was buying out their boss, a management buyout was eligible for 100% buyout. And I said, hey, this sounds great. Like, let's gather the package. We can help them get 100% financing. You'll get all your money up front, and it kind of makes sense for you as a seller to go this route, right? This was a few months before the SOP changed in June, and I followed up with him a week or two later, and the response was, "Yeah, I'm just going to work with my bank that I'm banking with." And over the course of the next few weeks, I was kind of in contact with him. It kind of, they dragged their feet, and then they told him, well, 100% financing for a management buyout is not eligible, which was completely incorrect at the time. He completely just spun his wheels, and then guess what? The SOP changed, and the whole deal died because the employees did not have the enough money for equity injection. He wasn't willing to hold a 5% on full standby for the loan. So a lot of it just boils down to miseducation and misdirection. That's really what it boils down to, and that's really what I try to do is educate, educate, and educate. But you can't always reach the masses.
Yeah, and it's important the SOP changed, and it is a federally run program. So Trump's in office when we're recording this, and Trump and the SBA can change it again if they want to. I don't know how fast they can change it, but they can change it. So as of December 17th, when we're talking, how does it work for a management buyout or a in company buyout if you sold to your employees or to a family member in the business?
So it doesn't actually change the structure of management buyout anymore, which is kind of unfortunate. It's kind of similar, just it's not any different than having a third party coming and buying your company. But the one thing you have going for you, it's not really SBA per se. It's more like from a lending perspective, and lenders getting comfortable for the deal. You have that qualitative aspect where, hey, I'm trying to sell to my current employee or managers who are managing the business for 10 years. It just makes sense to lend to that individual versus some third party who's coming to buy the company. So it helps from that perspective. It's but in terms of actual SBA underwriting, what's allowed, what's not allowed, it doesn't actually change anything because you're selling to an employee today.
It could change. I guess the thing it could change is speed, right? Because if you instead of going to market 6, 9, 12 months, if you come to someone like yourself, we talk to them, it could be faster. So, but maybe put some numbers on it. Let's say that you talk to an SBA lender and the value of the business was worth $3 million. On the day of closing, how much does the owner get, and then how does that earn out the seller's note, as you mentioned, the standby? How does that work on the back end?
So here's the thing: what the SBA currently allows is, right. We all love seller financing, and it's actually really favorable in an SBA transaction. It kind of gives lender a lot of comfortability knowing that the seller still has skin in the game. He's not going to leave the buyer high and dry because he's got to see his money. Now, what the SBA currently allows is technically the buyer has to bring 10% to the table as an equity injection, okay? So conceptually, a buyer could be that 10% and then get seller financing in and above that, and the SBA can come in, or the SBA lender could finance the gap, right, the difference. What the current SBA SOP allows is the seller can finance up to 5% of the required 10% of the equity injection from the buyer. So effectively, the buyer always has to bring 5% to the table, and then the seller can finance the other 5% of that required 10% equity injection. However, the current SOP basically says that the 5% that the seller is financing, the 5% of the buyer's 10% equity injection, has to be on standby for the life of the SBA loan, which means the seller cannot see a penny back on that for 10 years. Or if the SBA note is paid down sooner, they can see a repayment sooner. So effectively on a $3 million deal, just rough numbers, we're not factoring in closing costs or anything like that. If a buyer had to bring $300,000 to the table, the seller could finance 5% of that, okay? Or $150,000 over 10 years on full standby. So the seller would be walking away with $2.7 million at closing, basically. So I think that, like, from the seller's perspective, it kind of got a little bit tough to justify the full standby on seller notes that are part of the equity injection. But to be honest with you, we're going back to the roots a little bit. The SBA SOP changed a few times over the last
Yeah.
couple of years. this is the way SBA lending always worked. And yeah, getting sellers back on board with that full standby is sometimes a little bit tough, but sometimes it is the just the facts and the nature of the deal and how it has to be structured. And fact is, the seller is receiving the bulk of the sale price at closing.
Yeah,
So it
and
kind
so
of could make sense to get the deal over the finish line.
yeah, and I think it's perspective, right? And so there's $150,000 that you're kind of leaving on the table there, as you're saying, and so but there's a lot of talk about trying to get all seller financing or mostly seller financing, and this this is a lot better path than that because 150K is not a lot of, not a little bit of money. It's a significant dollars, but it's compared to what you were going to risk with a 50% note or a 75% note or a 100% note. This is a lot better path to get you paid up front, and then you hope you get that 150K. And of course, if you invest your money wisely, you can probably make most of that back, through good investments. And so I think that people hear that and they go, "Oh man, that's a risk." It's like, well, there's a lot of people out there talking to buyers about how to get deals with 80% owner financing or 90% owner financing, ignoring the SBA process. It's like, well, when you close, you want your money, as much money as you can get. And so if you can get all cash, great. But most deals, if they give you all cash, they're going to want you to stay around, or they're going to want something. They want to make sure that the money that they gave you, they can earn back as well. So there's trade-offs, right? No matter what you do.
Yeah, and there's a lot of different perspectives. I sometimes come across buyers who don't want any seller financing because, like, why do I need to answer to the seller, right? Like, if someone's doing an add-on, for example, right? They have an HVAC company, they're buying another HVAC company, right? Like, they know the space through and through. They've done their due diligence, financial due diligence, operational, legal. They know they could come and take this thing over on day one. Like, why do they need to answer to the seller, right? If the seller still has some skin in the game, they may not, right? They're kind of going to be on their case a little, make sure things are going smoothly, which is maybe not something that a buyer wants. So there's different angles, different perspectives, and I think the larger the seller note, the more the seller will be on the buyer's case, which again, conceptually could be very favorable in a sense, but at the same time, the buyer may not want the seller to be that involved or on top of them. If the seller is financing 50%, 75%, they're really tying themselves down to a seller. And to me, that could be incredibly unfavorable.
Yeah, I talked to an owner earlier this year, and he had done smaller deals. They're like 300K roughly, small shops. And the last one he had done was 100% seller finance. And, he's talking about that guy was really struggling. And so he wouldn't get his money out of that one. And he's like, well, this one's going to be seller finance too, probably. It's like, well, okay, you can do that. And he had no employees, so he really was kind of stuck on what his options were. But the risk was, for 300K in this case, maybe he gets none of it because the person who buys it goes out of business in 3 months. And so it's we all look at it and go, huh? So you really have to think about your risk tolerance in this and go, okay, what is my risk tolerance? And even if you think the employee that you want to sell the company to is, great, do you trust them with $3 million? And right, that's really the question. And if you do, then what's the risk of them getting the loan? Because to me, I've heard sellers say that. Well, I don't want to put that burden on them. It's like, well, you're putting the burden on yourself. $3 million bucks or 2.75. That's a lot to put to put the risk on. The other thing that I've seen come up, and I'm curious your thoughts on, is I had a deal where a company was going to sell, and the real estate was worth more than the company. The commercial real estate was worth more than the company. And for reasons I won't get into here, they couldn't sell the real estate as well. They had to sell just the business. But how often do you see that where the real estate is actually worth more than the business itself?
It's definitely not a common. It's definitely not a common thing. And were they asking? They were asked how much were they asking for any goodwill as well, or were they just like they were just trying to sell the real estate and that would
Well, the real estate was worth like 2.2 million, I think, and the business is worth like 500,000, something like that. They got the real estate for a really good deal when they got it, and the business wasn't. It was a fine business, but it just wasn't worth the real estate. And where they bought the real estate turned out to be a premium location. Like a lot of stuff from the real estate perspective went in their favor, and then the buyer though didn't want to buy or couldn't buy the real estate at the time, and so they had to put a note, and it was kind of a tough deal because there's a divorce. There's a lot of stuff that happened that really had to make the process go faster. They take less money, and they had this nice asset that they couldn't sell because the business was tied to it. And it's like, man, that was really tough.
So interesting when you have businesses that like don't really value, there's not much value there. Doing an asset sale with equipment or real estate is sometimes the way to go, right? Why a buyer would buy into that, right? That's up to the buyer and them getting comfortable with the nature of the transaction. But in a situation like that, buying the real estate outright could really be the solution. Additionally, because the real estate accounts for 51% or more of the value in the SBA world, the entire loan could be over a 25-year term, fully amortizing. So there's that benefit in general, which is, in this case, it sounds like the real estate was really the key value there. But even assuming the business did have value, the real estate had value, having the real estate as part of the loan can be incredibly beneficial in the SBA world.
Yeah. Okay, so there's a lot of talk, at least in the residential real estate world, about interest rates, right? And so I don't follow the interest markets. I don't know where they're at today, up, down, whatever. But how much does interest rates tie into buyers' appetites to come buy businesses? And are you seeing less or more demand based upon the current interest rate market?
I mean, the demand hasn't really dropped, to be honest, in the last couple of years. I mean, the market, to the contrary, the M&A space has kind of blown up, even in the higher rate environment. Now, naturally, if you have deals that are towing the line at a higher rate, it may be tougher to get them done. Buyers may lose interest much quicker in a deal because their debt service coverage is really not going to make it. Um, there is this, the SBA has a minimum 1.15 DSCR on deals, uh, which I don't really recommend on a business acquisition, even if you could toe that line. But the key is right, even in a higher rate environment, if the deal cash flows allows for a buyer to take home something to cover their expenses off the bat, I think it still makes sense to pursue a deal, and buyers seem to be taking that approach with the understanding that rates definitely seem to be trending downwards.
Yeah, yeah. No, it's interesting because the demand, as you touched on, and I've said this before, is that I'm 40. So when I was younger, when I bought my business, from my father, family-owned business, we did owner financing, but we didn't even know that the SBA hadn't even heard of that. Like it wasn't. I mean, it was around, but it wasn't as popularized as it is today. I remember going to this conference and met this SBA guy, and I was talking to him about doing it. He's like, no, you don't want to do SBA and all that stuff. I was like, okay, whatever. And now it is what everyone's doing. And so it's kind of a thing that's been around for a while, but the education, especially if you're an older owner, might not be there for you. If you're younger, you're kind of my age or younger, you're like SBA, 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 and it's like, okay, there's a lot of education that really has to go into this space, but it has created demand. But you touched on something there, is that if you're in this SBA range, and I know we can get above 5 million with some banks, but let's say 5 million or less, right? It is important to point out that unless you're some tech company that's trading on some kind of weird multiple and you're going to do an SBA deal, the value is kind of set by the SBA, right? So you've got to really work hard on how to make sure that you maximize your value from an SBA perspective as well. Of course, the buyer has an opinion on that, but you really have to make sure that you're satisfying the SBA.
Yeah, absolutely. I mean, really, the value gets set by an independent third party valuation company. Yeah, you kind of need to make sure that evaluation or the multiple you're looking to pay comes in line with what the an SBA lender would be comfortable with, right? If businesses in a certain industry trade at a 3x and you put in an offer for a 6x, and you're going to bring 10% and the seller is going to cover the gap, right? Lenders still need to make sure that they're doing prudent lending and the deal actually makes sense. So if you're putting an offer for $10 million, the seller's offering to finance $4 million, the valuation could only support a $5 million 7A loan. It may be tough to get a lender to back that, because again, from a prudent lending perspective, does the deal actually make sense, right? And prudent lending is kind of this little gray area where it's open to interpretation. You have the risk tolerance that every lender has that's unique to each lender. But as you start bridging that gap between what the valuation comes in at, what the cash flow allows, and what you're willing to pay, it's kind of just going to get tougher to get the deal done. So you need to make sure that you're putting in an offer that's realistic, that doesn't exceed what typical multiples are by a drastic amount. That's really how to get the deal done, you know?
So talk a little bit about debt. An owner might be comfortable with the debt that they have, they service, credit lines, stuff like that. How much does that factor into when you go to sell, especially with the SBA process? How do they value the debt, and how do they view that as a risk, or does it change valuation much?
I mean, any buyer who seeks to buy the company with an SBA loan, ultimately they'll have to take out the existing debt load that the seller has, right? The SBA lender will need first position UCC, so the seller has to make sure they're factoring that into the price. So if you have a company that's worth $5 million, right, valuation comes in at $5 million, and the seller has $3 million of debt on the books, he can't sell, right. He can't sell for $8 million, right. He's got to sell for $5 million, and at closing, $3 million of those proceeds will likely go to pay down the seller's existing debt load. Is that what you're asking?
Yeah, yeah, yeah. We had a deal with the company, and it was a auto dealership, and they were carrying a floor plan loan, and the SBA banks don't deal with stuff like that. And so they had the owner had allowed the floor plan loan to grow because of some of, yeah, right, some of the stuff we talked about earlier. But the value, but they had a dip in sales, not a tremendous dip, but a dip. The floor plan loan had grown significantly because the owner's like, whatever, I'm not worried about it. But when you go to sell, the SBA is like, no, the valuation took a pretty big dip, because they're like, no, this is too much risk for us. And so it was significant, and the owner didn't appreciate that for them to operate the business was fine with how they're doing it. They're pretty comfortable. They'd had it for a decade or whatever. But for the new buyer, for the lender, they looked at it as a huge, huge risk.
100%. Yeah, 100%. I mean, I've seen this over the years where a seller says, well, my company's worth $5 million. I got $2 million in debt, so buy my company for $7 million. Like, no, yeah, that's not the way that's going to work, you know?
So if we're talking a year from today, December next year, what's your prediction? Obviously, not this isn't going on the head of the Wall Street Journal. So this, what do you think is going to happen next year in the SBA world? More transactions? Are they going to go up, down, stay the same? What's your feel of the market right now?
I mean, like, I haven't studied the data closely, but it seems the program is growing year over year over year. A big part of the growth over the last couple of years has been like a lot of small 7A loans. There's a sub program of the 7A program where lenders were able to make loans originally up to 500,000. Now it's back down to 350 relatively quickly with lighter underwriting, 4 week turnaround time, and that has definitely been, I believe, a big driver of the growth over the last couple of years. The SBA kind of put the kibosh on that. They took a loss for the first time last year due to defaults. I do think that the program will definitely continue growing. I'm not sure if it will continue growing at the pace that we've seen over the last couple of years. However, rates are trending downwards, and it does push people to do things they wouldn't have done at a higher rate point. So I do think we'll see some growth. I'm not sure it'll be so drastic, but I do think we'll see some growth come a year from now.
Okay, well, thanks for your time today. This has been great. If people want to connect with you, they want to, sorry, if people connect with you, they want a loan, they want to find out the process or valuation or buy a business, where do they find you? How do they work with you?
Absolutely. Best way to reach out is to go to my website, Freedom Business Financing. The website is freedom, B as in boy, F as in Frank.com. Hit the contact form, provide as much information and context as possible. Will help us determine the time sensitivity and how urgent a call needs to happen. But that's really the best way to get a hold of us. Reach out through our website or even through LinkedIn. I'm very active on LinkedIn and X. Send a DM. I'm here to help anyone exploring SBA financing and help them get deals across the finish line.
Jerry, thank you so much for your time today, and look forward to connecting again in the future.
Absolutely. Thank you so much, Ron.